Hey everybody, not all investors get it right all the time, or even most of the time in a lot of cases. I'm certainly no exception. So today I'm going to talk about some of the worst performing investments in my portfolio and what I think about them now. Before we dive in, please check greenfool.com/Frankel. Get the top 10 stocks to buy right now. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel. All right, so I've already sold some of my bad investments. One of the best lessons I've learned as an investor over a long period of time is to know when to cut your losses. So a lot of my biggest losers are no longer in my portfolio. Um, I don't really believe much in concepts like, just hold it, hold it, hold it, no matter what. Just to name a few from the past few years, I invested in a SPAC IPO called 23andMe. Everyone knows that genetic testing company. Turned out to be a really bad one. Ticker symbol on that one was ME. I got rid of that. Another one that I really believe in the industry long term, but the company's just, it's too early, is OfferPad, OPAD. I got rid of that one. And recently I got rid of Zillow, which actually was one of my worst performers until I removed it from my portfolio. Fortunately, all three of those are really small positions for me. So I'm going to be talking about the three worst investments that I still own. So let me share my screen real quick. So the worst performing investment that's still in my portfolio is Lemonade, ticker symbol LMND. This is the insurance disruptor. It's down 64% from my cost basis. The stock itself is down over 90% from its peak. But fortunately, I did not catch it at the all-time highs. I bought a lot at significantly lower prices, so I'm in better shape than a lot of Lemonade investors. Now, the stock is down for a reason. At the time it was peaking, it was during the meme stock craze, and Lemonade definitely got caught up in that. And two, it was a different environment for companies that were unprofitable but growing fast. They pretty much had access to unlimited capital at very, very low costs. Lemonade definitely took advantage of that at the time. And investors just had a much bigger appetite for speculation in those days than they do today. The business itself is doing pretty well. Um, just over the past 2 years, their in-force premiums up by almost 90%, just to name one example. Their loss ratios are coming down. So I'm holding on to it today, and I plan to keep doing it. Three big reasons. Like I just mentioned, the recent results have been very strong. Number two, and this is for me the biggest of the three, is that we now have a clear path to profitability, whereas 2 years ago or so, that was not the case. And not only do we have a path to profitability, but Lemonade, it looks like they're going to achieve profitability quicker than they originally thought. Management is now expecting to be cash flow break even by the end of this year, 2024, and to have positive net cash flow in 2025, on the way to positive adjusted EBITDA and other profitability metrics. The company has tons of cash in the bank, a little over $900 million. You can see the market cap's just $1.25 billion. So the market is not putting a whole lot of value on this business. It has a ton of runway. If it can achieve its profitability goals while it continues to grow, this could be a big winner from here. From here, I don't necessarily know from the prices people originally paid for it, but from here it could be a big winner. So I'm holding on to my shares at these levels. Number two, my second worst performing company, and this one's actually a larger investment. Out of the three I'm talking about, this is by far the largest of the three investments in my portfolio, is Boston Omaha Corporation. I've done other videos about Boston Omaha recently, so check those out if you want a more kind of thorough dive into the company. But this is a holding company. It was often thought of as an early stage Berkshire Hathaway, even though I really don't like that comparison. One of its two co-CEOs was Warren Buffett's grandnephew. He's since left the company. But this is a holding company with three main businesses. They have billboard advertising, insurance, and they also have broadband infrastructure. They're in the process of winding down their asset management business. Essentially, all the more exciting things they tried to do didn't really work out. They were going to raise some third-party capital to create a real estate fund, to create a broadband fund, and using other people's money and kind of making fee income off it, kind of like a Brookfield might do. So that was an exciting thing that didn't really work out. They do own a pretty large stake in another publicly traded company called Sky Harbor, which is honestly my favorite part of the business right now. Um, the reasons I'm holding Boston Omaha still, even after it's really let me down, the management has really let me down in a few big ways. Um, three big reasons, a lot different than Lemonade, or two big reasons, rather. The stock is almost certainly trading below its net asset value today. The most conservative estimate I can do on its net asset value gets me around $18 a share. It's below 13 as I'm writing this or as I'm recording this. Um, so it's a cheap stock. If you add up the sum of the parts, it's almost certainly, even if they overpaid for some billboards and overpaid for broadband, and if their broadband takes longer than expected to cash flow, the current asset value is minimum of like $18 a share. It could take a while before that's worked into the stock price because honestly, I'm not the only one let down. The market's pretty let down too. So they're kind of discounting based on the fact that they don't really see a whole lot of strong execution here. Other than the Sky Harbor deal, they're really yet to impress me as an investor. But if you can buy an $18 for 13, you do that all day long. So I'm going to hold for that reason. And I mentioned one of their co-CEOs just left, which creates a leaner leadership structure, also a more efficient one. I've never been a fan of the co-CEO model wherever it's used. For one thing, now that you only have to pay one CEO salary, but that's the minor issue. The bigger issue is now you only have one person. Two people don't have to agree on every major decision. It's a leaner and more efficient leadership structure. I'm excited to see what now sole CEO Adam Peterson can do with it. I'm going to give him probably 3 or 4 quarters in charge to really show me something. But I'm definitely in prove it mode with Boston Omaha. I'm probably actually the one I'm least optimistic about. But again, trading at a pretty clear discount to net asset value. So I'm holding for the time being. And number 3, the third worst performing stock in my portfolio right now is Nextdoor. This was another SPAC IPO, but it was a little bit different. They went public through a company a blank check company that didn't have warrants. It was a much simpler deal than most were at that point in time, but it is still significantly down from its original $10 SPAC price. Market cap's about $1 billion, down 38% in my portfolio. It's down about 75% from the initial $10 price. I started adding when it got a lot cheaper. Pretty small investment for me, but still it's a significant one, and one that I like the company. It's a social network focused on neighborhoods, until led by Sarah Fryer, who was the one who built out Block, then Square's Cash App. She was CFO of Block. Now, Nextdoor has been kind of losing money and stagnating on growth lately. Sarah Fryer was a big part of why I bought it, but honestly didn't do a great job of executing. But now Nextdoor's founder just came back as CEO, and his whole philosophy is he's going to treat every dollar as it was his own. That's just generally the founder mentality, and can be a really good thing to have in a situation like this, where you really need to transition from a growth at all costs mentality that worked a few years ago into a growth, but let's do it responsibly mentality. So the founder just came back. He's already doing a good job of increasing efficiency. Their net loss really narrowed a lot in the latest quarter, for example. And that's just getting started. The growth numbers have not been impressive, but really don't reflect anything that the new leadership has done. The company has almost $500 million of cash and short-term investments, no debt. Great financial position to be in, a lot of runway to really get it right. And I honestly, this is not my reason for holding, but I honestly think Nextdoor is going to eventually be a takeover target. I think a lot of these SPACs that are very cash rich, but just have, they were losing money. They kind of went public too early and just were in growth at all cost mentalities. I think a lot of them are going to be acquisition targets, and I would not surprise to see Nextdoor go down that road. Especially because if you get $498 million of cash, you're essentially buying the business itself for $500 million, which for one of the more popular, not monetized, but one of the more popular social networks in the U.S. could be a bargain for the right company. So those are my three worst performers. I'm going to go ahead and stop my share. I'd love to hear what in the comments. First, ask me any questions you want about mine. I'm happy to answer any questions individually. And please, I want to hear what your worst investments are that you still own and why you're still holding them. I'm very interested in kind of when investments go wrong, what makes you hold, what makes you want to sell. So hope you enjoyed this video, and I'll see you next time. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.